Sense of question on our previous discussion, or do we have any question on previous discussion? Any question on our previous discussion? Okay. There are no questions on previous discussion. Kindly confirm that you can see my screen while we kickstart today's class. Hello, Wuni, can you confirm you can see my screen?
Yes, I can see your screen.
Good. Okay, if Wuni can see my screen, I don't care about anybody else. Yeah, not even the governor. So today, we'll be looking at intangible assets, IAS 38. Intangible assets is more like our IAS 16, property, plant, and equipment. The major difference we have between this standard and IAS 16 is the fact that while this is dealing with those assets that are not physical in nature, they are not assets we see or we can touch. IAS 16 deals with those assets that are physical in nature that we can see or touch. However, there are just a little difference aside that between IAS 38 and IAS 16. So in case you missed the class on IAS 16, this is a golden opportunity for you to also be able to get some things on IAS with our discussion on IAS 16. So IAS 36, IAS 38 applies to all intangible assets, except anyone that falls under the scope of another standard. Maybe the one that falls under goodwill in acquired business now, in a business combination now, that one is under the scope of IFRS 3. Intangible assets held as non-current assets held for sale will be under IAS, what's it called? IFRS 5. Maybe the one arising from employee benefit IAS 16, leases now IFRS 16, no longer IAS 17, because we don't have IAS 17 again. IAS 17 has been repealed by IFRS 16. So that is that. Now, what are intangible assets? Intangible assets, as defined by IAS 38, are just assets that are identifiable without physical substance. Assets that are what? Identifiable without physical substance. Without physical substance. That's the key thing there. They must be identifiable. That is, we must be able to separate it from the business, but they don't have physical assets. They don't have physical substance. They don't have, it's not something we can say, oh, this or this is it. So what are now those things what are those things that we must see before we can refer to something as an intangible asset? The first thing is that what? It must be an asset. It must be an asset. And for we to call anything an asset, if you look at what we have been saying, based on the description we've been giving assets when we're doing IAS 16, IAS 40, and so on, we say an asset is a resource that is controlled by an entity as a result of past events and from which future economic benefits are expected to flow directly to the entity. Those things must be present before we can call something an asset. It must be a resources. It must be something that is useful to us, that is controlled by that entity we are calling it an asset for. And it must have arisen as a result of past events. And it can generate future economic benefit. And that benefit will flow directly to the entity. When all of these things are in place, then we can call it an asset. If an asset does not have future economic benefit, we cannot call such an asset. If it cannot generate future economic benefits, no, we cannot call it an asset. If there is no control, we cannot call it an asset. And control, we say what? Control is the power to obtain the future economic benefits flowing from the resource. And it usually stems from legally enforceable rights. Before you can say you have control, you must have legally enforceable rights. Now, if someone should take my phone and without my permission, I can sue the person because I have legally enforceable rights over it. It is mine. That's why I can call my phone my asset. It is something I can control. But if it is something else now, if I don't have legally enforceable rights over it, then I cannot call it my, and I cannot call it my asset. Cannot call it my asset. Now, aside an intangible asset being an asset, aside when we establish that is an asset, the next thing that is also important is more, it must be without physical substance. It must be without physical substance. It must not be something we can actually see or we can touch. It must be something without physical substance. An example of it are like computer software. Computer software, all this ERP we use, all this Microsoft, we cannot see it. We cannot say, oh yeah, bring out my Microsoft, let me hold it. No, it doesn't work that way. So that's that. Things like patents, things like copyright, and so on, mastered, and so on. The next thing is that what? It must be non-monetary. It must be non-monetary. That is also very key. Before we call an item an intangible asset, it must be non-monetary. Non-monetary does not mean it doesn't have a monetary value. But what we are saying is we cannot state for a fact that this is the amount of money we'll get from it. This is the amount of money we'll get from it. See, we say monetary assets are defined as what? Money held, an asset to be received in fixed or determinable amount of money. Monetary assets are defined as money held, an asset to be received in fixed or determinable amount of money. So when it is not an asset that is to be received in fixed or determinable amount of money, then non-monetary asset. What that simply means is, if I say I have a receivable now, and I say, receivable, my receivables balance is 24 million. What that simply implies is that when I meet my receivables, or when my receivables wants to settle me, I'm expecting that fixed amount, 24 million. No more, no less. No more, no less. That's the actual amount I'm receiving. And I have legal rights over this 24 million. But when we talk of non-monetary assets, if we say furniture now, even if we say the value of our furniture is let's say 13 million, this 13 million is most likely an estimation, probably based on the cost at which we bought it or the fair valuation we did for it or so. But that doesn't mean that is the actual, or it doesn't mean we must make 13 million on it. That's why they will tell you, once you realize that the recoverable amount of the asset is higher than the carrying amount, right? Recognize impairment to write it down to it, because we know that amount is not fixed. So once we notice there are changes to it, we have to be adjusting and adjusting and adjusting it. And that's why you will notice when we were doing IS 36, they will tell you that you only allocate impairment of a CGU, a cash generating unit, to the non-monetary asset, because they are the ones that their value are not fixed or are not determinable. The monetary asset, their own values are determinable. So there is no way, or there is rare for us to have impairment for it. And when we have impairment for it, it will be separated. We will know it outrightly. Do we understand? Then it must be what? Identifiable. That's also a very key thing. It must be what? Identifiable. Identifiable. An asset is identifiable when it arises from contractual or other legal rights, or when it is what? Separable. Before we can say what? An item is identifiable, It is only where it arises as a result of contractual or other rights. Where it arises as a result of contractual or other rights, or where it is separable. Take for instance now, when we say copyrights, patents, all of these things, they are just legal rights. Franchises, DP list, brand note, brand name, all of these things, they are just legal rights. They are legal. Most of it are legal rights. And they say this work is copyright. It simply means the person has made the government and they've granted it that no, only you have access or only you have the right to utilize whatever is in this publication or whatever is in this intellectual property. If anybody use it, the person can sue because they have copyright over it. Are we getting it? And or when it can be what? Separated, when it is separable. That is, we can sell it, we can transfer it, we can rent it out or exchange it. That's what separable simply means. When all of these four are present in an asset, then we can say we have what? An intangible asset. An intangible asset. Which is what again? Assets. It must be an asset. It must be without physical substance. It must be non-monetary, and it must be what? Identifiable. It must be non-monetary and what? Identifiable. Identifiable. Do we understand? Any question at this point? Any question at this point? Any question at this point? Okay, no question. No question. Um, I like as you are doing it, Albert. I like as you are showing us that you know how to use reactions. For some of us that did not actually go to school. Thank you for teaching us well there. So that is that. Um Okay. Hello, everyone. Hello. So I left
Hello,
the
sir.
call. Nobody can even look for me that I was talking to myself. Oh. Okay, what did you guys hear last? So I can know where to take it from again. Because I've been teaching myself since. Hello. Wuni, what did you hear last? So I can know where to continue from.
From one mix up an intangible asset.
Okay, but we all understand. Do we hear anything about the initial recognition?
No,
Okay, I'll take it.
we stopped at identifiable.
Okay, I'll take it from there. Initial recognition. I've done all of this before. I don't know you guys were not hearing me. So I'll just take it again from my. Okay, so initially to recognize an intangible asset, just like any other asset, we must have established that it is an intangible asset. Looking at those four criteria, it must have been an asset, it must be without physical substance, it must be identifiable, and it must be non-monetary. Now, when we are able to establish all of this, then the normal criteria we have for recognizing an asset, which is that it must be probable that future economic benefits will flow directly to the entity, must exist, and the cost can also be measured reliably. What do we now do? For such intangible assets, we measure it, we recognize it in the books as a non-current asset. We recognize it in the books as a non-current asset. Now, for intangible assets, we must ensure that the probability of the expected future economic benefit is assessed using reasonable and supportable assumptions that represent management best estimates of the economic conditions that will exist during the asset useful life. What are we saying? Because it is intangible asset, we must always ensure that we assess the probability of the expected future economic benefit of it. And we do the assessment using what? Reasonable and supportable assumptions that are of management best estimates, so that we can be sure that they capture the economic conditions that will exist during the asset useful life. It is very, very important. It is very, very important. Now, how do we measure? We measure them initially at their cost. The cost will be the purchase price to acquire it, or the cost to internally generate it. Generate it. When we separately acquire an intangible asset, maybe you buy copyright now, or you buy a patent. That price that you have paid for it shows that there is a future economic benefit that will flow to the entity, because you wouldn't have paid for it or bought it if you are not expecting any future economic benefits from it. And then we can also estimate the cost reliably. Then recognition in that case will be somehow easy. To just be the purchase price, just like we said during under IAS 16. The purchase price of the asset, including import duty and non-refundable purchase taxes, after deducting trade discounts and rebate, and also any directly attributable cost of preparing the assets for its intended use, including employee cost, professional fee, and testing costs. Both. Now, let me just explain this. Remember when we were discussing under IAS 16 That the cost of an item of PPE, that's more like the cost of an item of intangible assets here now, will be the purchase price plus any other cost. Most importantly, the cost we incur to bring the asset to its condition of use, like what? Import duty and non-refundable taxes. We add it to the cost. While things like trade discounts, rebates, we take it out from it. Then, any cost that is necessary to prepare the asset for its intended use, maybe installation cost now, licensing cost, and all of those. They are also what? Part of the cost that you recognize for the asset. But it doesn't include advertisement cost or training cost or administrative cost or other general overhead costs. Now, just like we said under IAS 16, once an intangible asset is in working condition, any further costs incurred in relation are not recognized as part of this cost, except where the cost will increase its productivity or increase its useful life. Increase its productivity or increase its useful life. So now, where an intangible asset is acquired as part of a business combination, we are acquiring a business, and part of what we are paying for is goodwill. That is where we say that is when we can say that is where we can say, okay, it is acquired as a part of a business combination. Now, when it's acquired as a part of a business combination, then the price that was paid for the intangible asset, the price that is paid for the intangible asset will still be what? Just like if we are looking at the case of goodwill now, it may have its own separate price in the valuation if it's something like patent. But if it's something like goodwill, we just take it to be the difference between the fair value of the net asset you are acquiring and the purchase consideration. But when we have exchange transaction, maybe we exchange an intangible asset for another intangible asset. The cost for its initial measurement to be measured at what? At fair value. And we know what fair value is. Fair value is the price we receive to sell an asset or to transfer a liability in an orderly transaction between market participants at a measurement date. Please, can you guys hear me?
Yes, sir.
Okay. So,
Yes, sir.
but where we cannot measure it as fair value, maybe because the transaction lacks commercial substance, or the fair value cannot be reliably measured, then we can measure it at the carrying amount of the asset that is given up. We can measure it at the carrying amount of the asset that is given, that is the asset we are giving out. So, grants by government. When the government gives a grant to companies and is an intangible asset, maybe now government give you license to operate something you are supposed to pay for, they give you the license for free. Then what do? You record it at the fair value initially, or at the nominal amount plus any expenditure that is directly attributable to preparing it, the asset for its intended use. What do you mean? A license you are supposed to pay, let's say You are supposed to pay 2 million for it. Government is giving you for free. We are now saying, for the purpose of recording, such license should be recognized in your books at its fair value. Or maybe you have paid a nominal amount. Maybe maybe there is a nominal consideration. Maybe it's small, they just ask you to do something to get it. Then that nominal amount plus any other expense that is directly attributable to preparing the assets for its intended use. That's what we will attribute to it as its cost at the initial measurement stage. Now, internally generated intangible assets. Internally generated intangible assets. First thing first, internally generated intangible assets are the ones that an entity builds themselves. They are the ones that created it themselves, not that they acquire it from another entity, not that they acquire it from another entity. For IS 38 specifically says that internally generated goodwill should not be recognized as an asset. Internally generated goodwill. And you now see that, okay, the business net asset is 500 million, but the fair value, people are bidding for it to buy 600, 650. You cannot just go ahead and say we have a goodwill of 100,000. No, that's what the standard is saying. It's internally generated. The only thing that will make you recognize goodwill is where it is acquired goodwill. We call it purchase goodwill. That's the one you pay. The excess you pay over the acquisition of an entity. That's the goodwill we refer to when we are recognizing goodwill. Now, it might be difficult to assess whether an internally generated intangible asset qualifies for recognition or not. However, this will be as a result of what? Determining the cost of the asset reliably. It is so difficult, except you have a good tracking system. You will not be able to determine if the asset cost is reliable. And number two is that you don't know whether it is a bit difficult to distinguish between identifiable assets or not, and considering the fact that it must also generate future economic benefit. Now, having said that, IAS 38 prohibits recognition of some internally generated items outrightly, things like brand, goodwill, masthead, publishing titles, customer list. IAS 38 forbids recognizing it when it is internally generated. Now, what IAS 38 now further to say is that when we have internally generated intangible assets, we classify the cost into two phases: research phase and development phase. Research phase and development phase. How do we treat all of these two? Research phase. Research phase is the phase where the entity is carrying out original and planned investigation with the purpose of gaining new scientific or technical knowledge and understanding. That's what we call research stage, where we are carrying out a planned investigation with the aim of gaining new scientific or technical knowledge and understanding. You want to start producing something. You are now carrying out an investigation to gain new scientific or technical knowledge and understanding. That's what we call the research phase. That's what we call the research phase. And the activities at that stage include what? Gaining new knowledge, searching for application of research findings, search for alternatives to materials, products, and processes, and so on. Now, IS38 is of the view that in research phase is part of an internal project, and it will be difficult to prove that an asset exists. An asset exists because we don't even know if it will generate future economic benefit or not. So what does the standard ask us to do? The standard asks us that what? Costs incurred at the research phase should be what? Should be expensed. It should be expensed. It should be written off as an expense, as an expense in the year it is what? Incurred. In the year it is incurred. In the year it is incurred. That is that. So when we have research costs, so far it is costs we incur to carry out a planned investigation that is with the prospect of gaining new scientific or technical knowledge and understanding. We what? We expense the cost to our SOP as we are incurring it. At the development stage, it is now the application of our research findings at the research phase and other knowledge to plan or design for the production of new or substantially improved material, devices, products, processes, or services before the start of commercial production or use. What are we saying? Say the application of that findings we got during our research phase. So when we are now using the knowledge we gain from the research phase, we are now using it to develop products. That is what we call development stage. Now we need to understand something here. We need to be able to differentiate. Now for development phase cost also, the standard says we should keep expensing. We should keep expensing the standard says we should keep expensing the development phase cost until it can be until an asset is arising from the development stage. And before we can say an asset is arising from that development stage, the following must be demonstrated. One, there is technical feasibility of completing the asset. You have the technical know-how of completing the asset and making it ready for sale or for use. Two, the entity has the intention to complete the asset. The entity must also have intention to complete the asset and use or sell it. Number three is that the entity has the ability to use or sell it. You know, there is possibility you don't have the ability to use it. You may not have the ability to do it, but that's not an issue. The next one is that the assets will probably generate future economic benefit. When we use probably in account, it means we have more than 50% chance of the things occurring. If the asset has a higher chance that it will generate future economic benefit, then we have to look at the availability of technical, finance, and other resources to complete the development of the work. Are we getting it? Hello, can you hear me? So
yes, sir.
once all of these conditions are met, then we can now start capitalizing development cost. However, any development cost that has already been any development cost that has already been expensed before they meet the recognition criteria of it being taken as sorry, any cost we have incurred on the development which we have expensed before it meets the criteria and we are now capitalizing it.
That's
That says
the
the standard says we cannot take it back again. We cannot take it, we cannot say no, we don't want it to be an expense again. We want to capitalize it. No. The standard is saying we should treat all of it as the as expenses. Till those criteria are till those criteria are met. Till those criteria are met. So when an asset is internally generated, the aggregation of the directly attributable cost is what we take to be the cost of the asset. So that is that. Um, for subsequent measurement of intangible assets, we also use maybe the cost model or the revaluation model. And just like cost model is cost less accumulated depreciation, less impairment. If we have, in this case, it will be cost less amortization, less impairment if you have. While revaluation model, just like we know, valuation model is where we take the revalued amount less subsequent depreciation, That is that on that. I've already explained how evaluation should be treated. Okay. So I've already explained accounting for evaluation gain or losses. I don't think that is new to us. Amortization just have to do with we spreading the depreciable value of the asset to. Okay. Having said that, yeah, amortization of intangible assets. Intangible assets are amortized over the length of their useful life, just like we do for owner occupied property in IS 16. You amortize it over its useful life. However, if we have intangible assets with indefinite useful life, we must be able to determine the useful life of an asset. So what do? We look at things like what's the expected usage of the asset by the entity. How long do we intend to use it for? If there is public information and estimate of useful life used in similar ways, that is where the asset does not have the business cannot that is where we are unable to determine the useful life. We look at the technological, commercial, and other types of obsolescence. We look at the stability in the industry in which the asset is being used, and we look at the expected action by our competitors. When all of this is sorted, can now go ahead to what? To do this thing. So now, when an intangible asset has an infinite useful life, all we should just do is to make sure we okay. So that is basically that. And I've already told us about disclosure requirement. Disclosure requirement has to do with what are those things you are showing users of the financial statement that can inform their judgment on the decision they will make with the financial statement. So I think that is that on that. That is that on that. So please spare me like 5-10 minutes, then we'll continue by continue by solving questions. Any question for me at this point? Any question for me at this point? Okay, I'm with you. Someone said, does anyone have any question?
No.
No, sir.
Okay, let's just take
Hello, sir.
He said we are on vehicle for 10 minutes. That's why I can.
Madam Kehinde, you are back. Hello, everyone. Okay, welcome back, everyone. Let's quickly look at few questions, and we'll call it a time on IS 38. On IS 38, we'll just quickly see what we can do. Okay, let's start with question one. Who is reading for us? Hello, can you guys hear me? Hello, can you guys hear me?
We
I
can hear
can
you,
hear
sir.
you.
Okay. So we have distinguish between research expenditure and development expenditure. We said what? Research expenditure. Research expenditure is the expenditure we incur to gain scientific knowledge through a what? A through a predetermined investigation about something. I mean, while 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 development expenditure is the expenditure we incur when we are applying the knowledge gained from the research field into the development of what we have researched about. Into the development of what we have researched about. Now, they said explain the accounting treatment required by IS 38 in relation to each of these type of expenditure. For what's it called? For research expenditure, we have said that what? It is what? For research expenditure, it is to be what? It is to be expensed in the statement of profit or loss. While for development expenditure, it will be expensed till it meets the criteria, till it meets the criteria. When it meets the criteria, then it will now be what? It will be capitalized. It will be capitalized. It will be capitalized. And what are those criteria? There are those 6 things we mentioned. There are those 6 things we mentioned. It is at that point it will be sorry. It is at that point it will now be what? Capitalized. It will be capitalized. So what do we do? Next one, they said during the year to 31 July 2014, a pharmaceutical company spent a total of 830,000 on research and development. Of this amount, 370,000 was spent on an unsuccessful attempt to find cure for the common cold. The remaining 460,000 was spent on the development of a new range of cosmetic products. How should this expenditure be accounted for in the company's financial? Okay, so we'll just have IAS 38 intangible assets. We have research cost. research cost 370,000 should be expensed in the financial statement. And the double entry would have been to debit what? Debit research expenditure and credit the bank where the payment was made. Or if payment is yet to be made, we credit payable. While development costs of 460,000 should be capitalized. Why are we capitalizing it? Should be capitalized because they said they have used the money for the development of a new range of cosmetic products. So if they have been able to develop it, that means they meet the recognition criteria, except they now tell us otherwise. Should be capitalized in the financial statement. So what will be the double entry for that? The double entry will be debit intangible assets, development cost, and credit what? Bank or payable. Do we understand?
Yes.
Okay, good. Okay, since that is well understood, let's move straight to question 2. We have on 1 January 2014, A Limited bought all of the assets and liabilities of B Limited for a price of 500,000. B Limited then went into liquidation. The financial statement of the two companies just before the purchase were as follows. We have all of this, and we're told that the fair value of the assets and liabilities of B as at that date we agreed to be as follows. We are asked to calculate the amount paid by A Limited for the goodwill of B Limited. Now, this is a goodwill acquired by way of business combination. And how do we do it? I believe we all have done group accounts, so we should be able to know how to calculate goodwill. Goodwill will be calculated by saying what? Question 2. Calculation of goodwill. So to calculate goodwill, I will say purchase consideration. They told us they bought the whole assets and liabilities for how much? For 500,000. Then what do? We less fair value of net assets. For group students, I know you'll be wondering, why am I not bringing NCI? They told us they bought all of their assets and liability. That means it is 100% acquisition. So we don't have non-controlling interest here. So we are using fair value, not book value. So we cannot use the statement of financial position figure since we've been given fair value. So we'll say fair value, PPE, 390,000, inventories, 160,000, trade receivables,
80,000.
80,000. Then current liabilities. Because this is a liability, it will be a reduction to our asset. But that's not all. Don't forget, in our group account, they will tell us something like the difference is as a result of one asset or the other. So we have to check if there are any other asset they acquired that we don't know of here. The only asset they have here is PPE. We've already taken that is fair value. Inventories, we've taken that. Receivables, we've taken that also. Liabilities, they only have current liabilities, and we've taken all of that. So we are good to go. So what will this give us? Figure. I want to believe you guys have calculated.
150.
What do you call it?
450,000.
450,000.
450,000. So if that is 450,000, then what they paid for the goodwill would be what? 50,000.
50,000.
50,000. Then the next requirement asks us to prepare statement of financial position for A Limited as it would be after the purchase of the net asset of B. So we'll say statement of financial position A Limited as at 1 January 2014. So what do we have? We'll have figures quoted in thousands, non-current assets. We have PPE. Our PPE will now be what? They had 4,320, and the new one they bought is what? 390. We will not use the 460 because that one is book value. We bought at fair value, which is 390, and that will give us how much?
4,710.
5,710. Then we now have a new asset, which is what? Goodwill. We don't forget we paid for it, Abby.
Sir, 4,710.
4,710. 4,710.
Okay, thank you. Don't beat me, eh? And that be okay. Then we go to current assets. We have things like what? Inventories. Inventories, which will be 1,210 plus 160 fair value. And that will give us how much?
1,370. 1,370.
Then trade receivables, which is 940 plus 80.
1020.
Then bank, cash at bank. How much? 1,650. But don't forget, they told us the purchase of that other entity was paid for from their bank account. That's why we'll be deducting the 500. And that will give us how much?
1,150.
Summation, please. Equity will just be ordinary share capital,
Summation of the current assets is 3,540.
3,540. So what do we have as the total assets?
8,300. 8,300.
8,300. So retained earnings, don't forget, what they acquire wasn't equity. So their equity wouldn't have changed. Their equity will still remain the same. However, non-current liabilities we have that to be 2,500. And for current liabilities, we have that to be 970 plus the new one they acquire, which is 180. And that will give us how much? That will give us how much?
1,150. 1,150.
So what do we have in total?
8,300. 8,300.
8,300. Okay. Okay. So let's look at question 3. They said in recent years, it has not been unusual for the premium paid to acquire control of a business to be greater than the fair value of its intangible net asset, of its tangible net assets. The increase in relative proportions of intangible assets has made the accounting practices for them all the more important. During the same period, many companies have spent a great deal of money internally developing new intangible assets such as software and brands. IS 38 prescribed the accounting treatment for the following for intangible assets required. In accordance with IS 38, discuss whether intangible assets should be recognized, and if so, how they should be initially recorded and subsequently amortized in the following circumstances: when they are purchased separately from other assets, when they are obtained as part of acquiring the whole of a business, when they are developed internally. And I believe all of these are part of our previous discussion, which where you shared the notes so far. You will see all of the explanation there. Intangible assets should be recognized if either it is bought out separately or as part of a business combination, or it is internally generated so far it meets the recognition criteria. How should they be initially recorded? We record them at their cost, at the cost price, at the price at which you have bought it. Does any other cost to incur to bring it to a condition of use? And how should they be amortized? When they are purchased separately from other assets and they have a finite useful life, we amortize it over their finite useful life. When they are obtained as part of acquiring the whole of a business, if it has its finite useful life, you still have the amortize it over its finite useful life. And even when they are developed internally, if it has a finite useful life, you still amortize over its finite useful life. But where it doesn't have a finite useful life, then what do? You have to what? Or you will be testing it for impairment every year. And when there is impairment, you impair it. And if at any point in time the useful life now becomes finite, it now becomes known, you have to what? You have to start amortizing from that year. Is that clear? Is that clear? Am I talking to people?
Yes, very clear.
Okay.
Yes.
An assistant of yours has been criticized over a piece of work that he produced for his study course for giving the definition of a non-current asset as a physical asset of substantial cost owned by the company which lasts longer than 1 year. Provide an explanation to your assistant of the weakness in his definition of non-current asset when compared to the International Accounting Standard Board view of assets. So can anyone correct this thing? Can anyone tell us what is wrong with that definition? Hello? Hello?
Hi.
Can anyone dissect the what is wrong in that question? In that definition, sorry.
Good evening, sir. I
Good
think is
evening.
the nation of the non-current assets that was interchanged for current, I believe, right? For current assets. Okay, sorry. I think it's the substantial cost that was added to it.
Okay. For
So
for me,
owned
the
by a company
definition is
which will
very quick.
last longer
Huh?
than. Okay, continue, sir.
The definition is very weak. First thing first, when we call something an asset, it must be a resources. It doesn't have to be physical. It doesn't have to be physical. Huh? Just like we are discussing intangible assets now. They are also assets, but they are not physical. Then it is what? It must be controlled by the entity. She did not put that here. Owned by a company. An entity may not even own an asset, but when they are controlling it, it's an asset, just like a leased asset. Just like a leased asset. It doesn't have to be for a substantial cost. Regardless of the cost, so far control is there and it's the resources. If it meets other criteria, then it is still an asset, regardless of the cost. That's there. The next one is that what? It must generate future economic benefit. It's not about lasting for more than 1 year. Even if it's lasting for more than 1 year, is it generating future economic benefit? Take for instance now, if you buy waste bin will definitely serve you more than 1 year. But does that make it an asset? Is it generating future economic benefit? No. So it's not an asset. That's another one. And it must be what? The benefit must flow directly to the entity. When all of these things are in place, that's when we can call it an asset. If they are not there, we cannot call it an asset. That is that. Can someone read question 4 for us? Question 4, can someone read?
The following information relates to three companies that use the evaluation model in relation to intangible assets and prepare annual financial statements to December 31st. A. Company W acquired an intangible asset for 250,000 on December 31st, 2012. This asset was revalued at 225,000 on December 31st, 2013 and 270,000 and at 270,000 on December 31st, 2014. B. Company X disposed of an intangible asset on December 31st, 2014. This asset had been acquired some years previously at a cost of 100,000 and had a carrying amount of 160,000 on the date of disposal. The disposal proceeds were 195,000. C. Company Y acquired an intangible asset for 80,000 naira on December 31st, 2012. This asset was revalued at 90,000 naira on 31st December 2013 and 65,000 naira on December 31st, 2014. Describe the circumstances in which the revaluation model may be used in accordance with the requirements of IAS 38 and explain how each of the above matters should be dealt with in the financial statement of the company concerned.
Okay. So this is just trying to test our knowledge of the valuation model. So for us to use the valuation model, the standard actually give us the, for subsequent measurements, can either do what's it called? Can either do cost model or you do the valuation model. However, once you choose that you want to use the valuation model, you have, once you choose a model, you have to continue using it, or you have to use it for all assets that falls within that class. I mean, if you decide to use it for a class of intangible asset now, all assets, let's assume you want to use it for one copyright now. All copyrights must be done on evaluation model. Must be done on evaluation model. Now, for company W, for company W, what we'll do is, if the asset was acquired for 250 at the end of 2012, and it was revalued to 225 on 31 December 2013, revalued to 270 on 31 December 2014. The only thing we can do here is to calculate the valuation difference. So to calculate the valuation difference, in 2013, we'll say revalued amount 225,000 less cost 250,000. So that means we'll have a revaluation deficit of 25,000. If we have a revaluation deficit of 25,000, the double entry will be to debit SOPL with the 25,000 and credit the intangible asset. Because when we have a deficit on an asset, we write it off to our SOPL directly. Now, however, in 2014, and we are not taking cognizance of depreciation or amortization here because they did not give us the useful life of the asset or any information to calculate the useful life, to calculate the depreciation. But if they have given us, then we will definitely use it. So for 2014, we'll just say revalued amount at the end of the year, which is revalued amount for 2014, which is 270,000, less revalued amount at the beginning of the year, 2013, which is 225,000. And that will give us how much difference?
45.
Revaluation surplus. 55, Abby?
45. 45.
45,000 surplus. Now, ideally, the surplus will be taken to surplus, evaluation surplus account through OCI. But because this asset has initially suffered a deficit, we'll first go and write off the deficit. And by saying what? Debit the intangible asset with the 45,000. Credit SOPL with the 25,000 we initially put there as deficit. Then the remaining 20 will now credit that to revaluation surplus to OCI. Revaluation surplus or OCI 20,000. Do we understand? Do we understand?
Yes, sir.
Okay. So for company X, what we can only do for company X is to calculate gain or loss on disposal. Calculation of gain or loss on disposal. What do we have? Disposal proceeds. $195,000. Less carrying amount. The asset had a carrying amount of 160,000. So we have gain on disposal to be 35,000. Gain on disposal. However, how would this have been accounted for? We would have said for this disposal proceed, we'll debit cash or bank or receivable where the person is here to pay and credit disposal account. For the carrying amount, we'll debit disposal account and credit the intangible asset account. While for the gain, we'll debit for the gain. What do we debit? For the gain, what do we debit? We'll debit it to the disposal account and credit SOPL. Do we understand? Do we understand? Hello?
Yes, sir.
Okay. For company Y, he gave us the cost of acquisition and the revalued amount. So we are calculating the valuation difference also. So we have for 2013, the valued amount is how much? 90,000 with less cost, 80,000. So that's a surplus of 10,000. So in that surplus, we'll debit intangible assets account and credit evaluation surplus through OCI. Then in 2014, we now have revalued amount at the end of the year, which is 2014, to be 65,000. will let's revalue the amount at the beginning of the year. Which is 2013, and that is 90,000. So this gives us a difference of how much? 25,000. A revaluation deficit. And the double entry for that will be to debit revaluation surplus account, because you have money in revaluation surplus account 10,000, but you will only debit it with 10,000. You will debit SOPL with the remaining 15,000 because it's a deficit. The reason why the whole 25,000 is not going to SOPL is because they have an existing surplus on the asset. Then credit intangible assets with the whole 25. With the whole 25. Do we understand? Do we understand?
Yes, sir.
Yes, sir.
Okay, let's look at question 6. Who is reading? Green Life is a publicly listed
Greenlight is a
pharmaceutical company.
publicly listed pharmaceutical company. During the year to 31st December 2009, the following transactions took place. $6 million was spent on developing a new obesity drug, which received clinical approval on 1st July 2009 and is proven commercially successful. The patent was registered on 1st July 2009. It cost $1.5 million and remains in force for 3 years. A research project was set up on 1st October 2009, which is expected to result in a new cancer drug of $200,000. $200,000 was spent on computer equipment and $400,000 on staff salaries. The equipment has an expected life of 4 years. On 1st September 2009, Greenlight acquired an up-to-date list of GPs at a cost of $500,000 and has been visiting them to explain the new obesity drug. The list is expected to generate sales throughout the life cycle of the drug. Required. Tapu screw. Required. Prepare extracts from the statement of financial position of Greenlight and at 31st December 2009 relating to the above items and summarize the costs to be included in the income statement for that year.
Okay. So on this question, we've been given three different scenarios that occur with Green Life Pharmaceutical Company. So what do? We have 6 million was spent on developing a new obesity drug, and it has received clinical approval. For the drug to have received clinical approval and is even proven commercially successful, that means the development cost has made the recognition criteria. The patent was registered on 1 July 2009. It cost 1.5 million and remain in force for 3 years. So what do? We say Green Life Pharmaceutical. The space we have here is not enough. So let me just take the new this thing. Okay. I believe you can see my screen. We have Green Life Pharmaceutical. What do you say?
I think we can see your screen now.
So we have one, development cost of the obesity drug, 6 million. So for that development cost alone, which is an intangible asset on its own, we'll charge annual depreciation for it, or depreciation charge for the year. So let me call it annual depreciation. Depreciation, or don't, sorry, let's use the right balance. Amortization charge. Amortization charge. Because they've told us that what? If the patent on the drug is for 3 years, that means the drug itself is also expected to last for 3 years. Amortization will be what? The 6 million divided by 3 years, multiplied by what? They got the clinical approval on July 1, 20X9. July 1, 20X9 to 31 December 20X9. That should be 6 months. So times 6 divided by 12, that will give us what? I'm with you.
One.
Huh?
1 million.
1 million. Okay. For the patent, they said the patent cost 1.5 million. And it will remain in force for 3 years. So we'll amortize that too. Amortization of the patent will be 1.5 million divided by the same 3 years, multiplied by 6/12. And that will give us how much?
That's 0.25. 25,000.
25,000.
Yeah.
25,000 or 250,000? 0.25, Abby?
Yes, sorry, 0.25. That's
0.25 million. That should be
yeah.
20,000. So that's that on the first part. A research project was set up on 1 October 20X9, which is expected to result in a new cancer drug. 200,000 was spent on computer equipment and 400,000 on staff salary. The equipment has an expected life of 4 years. What do we do? For this, we'll say B. Research cost. Research cost will now be what? Depreciation of computer equipment. Now, because the computer equipment wasn't used for the business, it was used for the research purpose. So the depreciation of that computer equipment will be seeing it as a research cost. So we'll say what? 200,000 divided by 4 years, multiplied by, they said they set up the research project on 1st October. October to December, October, November, December is just 3 months. So times 3 divided by 12, That will give us how much? Then staff salaries,
12,500.
12,500. Salaries is what? 400,000. So that will give us a total of 412,500, which will be the research cost. Note C, they said on 1st September 20X9, Green Life acquired an up-to-date list of GPs at a cost of 500,000. GPs are general practitioner. It's just like list of doctors. That's so, and they have been visiting them to explain the new obesity drug. Which new obesity drug are they talking about? The obesity drug in number 1. So they acquired a list, a customer list, and they have been visiting them to explain the list is expected to generate sales throughout the life cycle of the drug. So what do we have? We have customer list. Customer list is also an intangible asset, 500,000. So the way customer list works is that, let's just say now, a business has already run an analysis and they have maybe the details, the name, the address, the phone number, the emails of people that can be your home potential customer. So if they are to give you such information, they will not give you for free. They are selling it to you. And since you are not expecting, since once they sell it to you now, it becomes a resource to you. It becomes a resources to you, and you have control over it. You do whatever you like with the information they've given you. It is also not, it is also what? It is also without a physical substance, because it's not as if those people are your own, but you have their information. The information is what you have, which is not a tangible this thing. Then it is also what? It is also identifiable. It can be separated. You can give it if even the company you are buying it for is selling it to you, because it can be separated from their home business. And aside that, it is also what? Yeah, it is also non-monetary. It is also non-monetary. So since it checks all of those lists, then we can asset. You can refer to it as an intangible asset. So that means we are also to amortize it. Amortization. However, the amortization will now be 500,000 divided by how many years now? They told us it is expected to generate sales throughout the life cycle of the drug. The life cycle of the drug, which we established up there, is 3 years. But that 3 years was from 1st July 20X9. But they got the GP list for September 20X9. That means that's how many months? July, August. So 2 months out of the 3 years is gone. So that means it will be remaining 34 months. So the best thing is to say this divided by 34 months, multiplied by what? September to December is 4 months. Multiplied by 4 months. And this will give us how much? Figure.
Um, 58,824.
58,824. Okay, that's the amortization. So having done all of this, we can now do an abridged. So we are asked to summarize the cost. We should prepare stance from the statement of financial position. So let's just say SOPL extract. for the year ended 31 December 20x9. So we don't have any income here, but we have expenses. What are the expenses? We have amortization. And the amortization will be, we can take everything together, 1 million plus 1 million. Let me make it full figure. 1 million plus 250,000 plus 250,000 plus what? Plus 58,824. Those are the amortization. Then we have research costs. Research cost. What do we have as the figure? This should be 1 million 308 1,308,824. While research cost will be 412,500. Statement of financial position extract. As at 31 December 20x9. We'll have what? Non-current assets. PPE. What is the PPE we have? The PPE we have will be the computer equipment. Don't forget, computer equipment is a PPE to us. Computer equipment. And it should be what? We are recognizing it as carrying amounts. So it should be 200,000 minus 12,500. That is 170 what? 170 what? I think that should be 177. Is it 177 or 187?
187,500.
7,500. Then what else do we have? Intangible assets. Intangible assets. What are the intangible assets we have? We have development cost for the obesity drug. 6 million minus the amortization of 1 million. That will give us 5 million. The patent is 1.5 million minus the depreciation charge of 250,000. That will be 1,250,000. Then the GP list or customer list of 500,000 less the depreciation of 58,824. How much?
So I can't see your screen again.
Oh yeah, buy new data. Can they buy new data? Or can others see my screen?
Yes.
I
So
have data, sir.
buy data. Oh. Okay, so that is that. That is that. That is that on that solution. Kò bá thinking. Òun láti ṣe yẹn. So in order not to delay us too much, I'll just because question 7 is just an explanation, I will explain that for us, and we might just call it a time from there. Or let's just see. So we have question 7. Your assistant has encountered the following matters during the preparation of the draft financial statement of Secretary PLC for the year ending 30th September 2009. He has given an explanation of his treatment of them. We have what? Secretary PLC spent 200,000 sending its staff on training courses during the year. This has already led to an improvement in the company's efficiency and resulted in cost savings. The organizer of the course has stated that the benefits from the training should last for a minimum of 4 years. The assistant has therefore treated the cost of the training as an intangible asset and charged 6-month amortization based on the average day during the year on which the training courses were completed. Is that right? No. Beautiful nonsense. Question 7. IS 8 specifically says training costs should not be capitalized. In line with IS 38. Because even those you are training, they can wake up tomorrow and say they are not working for your company again. We now say they cannot go to their house because you train them. They definitely can go. So you cannot capitalize training costs. You cannot. You cannot capitalize training costs. It should be expensed in whatever period it was incurred. Number 2, they said, well, during the year, the company started research work with a view to the eventual development of a new processor chip. By 30th September 20X9, it had spent 1.6 million on this project. Secretary PLC has a past history of being particularly successful in bringing similar projects to a profitable conclusion. As a consequence, the assistant has treated the expenditure to date on this project as an asset in the statement of financial position. Wrong. They are still at the research phase. And IS 38 says what? Research costs should be expensed. Research costs should be expensed. That's the 1.6 million. That's one. Then what else? They said, even though they have past history of bringing it to a profitable, they are still at the research stage. They have not started development. If they have started development now, here is a different scenario. But if they are still at the research stage. Number next, they said secretary was also commissioned by a customer to research and if feasible, produce a computer system to install in motor vehicles that can automatically stop the vehicle if it is about to be involved in a collision. At 30th September 2009, Secretary PLC has spent 2.4 million on this project. But at that date, it was uncertain as to whether the project will be successful. As a consequence, the assistant has stated the 2.4 million as an expense in the income statement. Is that right? No. Why is it not right? They are commissioned by a customer to research. So that thing the cost they are incurring is for the customer, not for them. So the cost incurred research cost incurred on behalf of customer should be treated as a contract asset in Secretary PLC books. What does that mean? It means that because the research is not for their entity, they are not the one carrying out the research of their own volition. It is the person that told them to do that analysis that will be responsible for the what? That will be responsible for the research cost. So in their home books, they will treat it as a contract asset if they are yet to invoice the person. If they have invoiced the person, they will treat it as what? As a receivable. So we move on. They said Secretary manufacturing facilities have recently received a favorable inspection by government computer scientists. As a result of this, the company is expected. The company has been granted an exclusive 10-year license to manufacture and distribute a new kind of computer chip. Although the license has no direct cost to Secretary, his board feel his granting is a reflection of the company's standing, and they have asked a firm of independent specialist advisors to value the license. Accordingly, they have placed a value of 25 million on it, which the assistant has capitalized in the statement of financial position. Yes. When government grant is received at no cost or at a nominal cost, you have to recognize it at its fair value. And since this one has a fair value, they valued it and is at 25 million, should be recognized as a non-current asset. It should be capitalized. Capitalization of government grant license is correct. We can capitalize it. Next, we have what? In the accounting period, Secretary PLC has spent 15 million sending its staff on specialist training courses. Whilst these courses have been expensive, they have led to a marked improvement in production quality, and staff now need less supervision. This in turn has led to an increase in revenue and cost reduction. The directors of Secretary PLC believe that the benefit will continue for at least 4 years and wish to treat the training cost as an asset. The assistants agree with them and has recorded it as an asset. No, training costs are to be expensed when incurred. That is that on the case of Secretary. Any question? Any question?
No, sir.
Okay. Can we quickly go to question 9? I want whatever we are doing by 11 o'clock on the dots, we are out of here.
Okay. Question 9. Should I read?
Yes, ma.
Okay. Ewiyomi Pharmaceutical is a public limited company. It has been considering the accounting treatment of its intangible assets and has asked your opinion on how the matter below should be treated in its financial statements for the year ended 31st December 2016. Evi Eviomi Pharmaceuticals has developed and planted and patented a new drug, which has been approved for clinical use. The cost of developing the drug were 25 million naira. Based on earlier assessment of its sales success, a firm of experts has estimated its market value at 37 million. In June 2016, EP paid 18 million for a television advertising campaign for its product that will run for 9 months from 1st July 2016 to 31st March 2017. The director believed that increased sales as a result of publicity will continue for 3 years from the start of the advertisement. Required. Explain how the directors of EP should treat the above in the financial statement of the year to 31st December 2016.
Okay. Okay. So in this case, Eriomi Pharmaceutical, they've developed and patented a new drug. The cost of developing the drug, 25 million, and they have estimated its market value to be 37 million. Don't forget, we record an asset at lower of its cost and its what? At the lower of its cost and its realizable value. So, or recoverable value. So, even though the assets, has a market value of 37 million, we will not use the 37 million because it actually cost them 25 million. However, let's assume when they estimated the market value was just 20 million. Then we will need to recognize the drug initially at 25 million and recognize an impairment on it of 5 million, because then the recoverable value is now lower than the cost. But since that wasn't the case, we don't have issues. You can see question 9. Eriomi Pharmaceuticals. We have 1, development cost of the drug. $25 million. So, did they tell us when they finish? They did not tell us when they finish developing the drug or anything. So we don't know. There is no way we can calculate amortization for that. Then for the television advertisement campaign, it will run for 9 months, but it will run from 1st July 2016 to 31 March 2017. The directors believe that the increased sales as a result of the publicity will continue for 3 years. It doesn't matter. Advertisement cost is what? 2. Advertisement cost should be expense. Advertisement cost should be expense, even if the benefit will last them for more than 1 year. Advertisement cost should be expensed. However, only 6 months, which is 1st July, only 6 months will be expensed in the current accounting year. 1st July 2016 to 31 December 2016 should be expensed. in the current year, while that of 1 January 2017 to 31 March of 2017 should be treated as what? Should be treated as prepaid expenses. Should be treated as prepaid expenses. So that is just all we have on that question. That is just all we have on that question. So do we call it a time or we look at question 10?
That is the time.
I never said I can't see the time. I'm asking a question. Should we call it a time or we look at question 10? Thank
Let's
God you
call
are
it
not,
a time.
thank God you are not going to work tomorrow.
Even though
So my own is just make sure you take your time to go through all of these things. If you look at question 10 now, they are giving us research and development project progress. Project A that was completed at the end of 2011 has a development expenditure brought forward at the beginning of 2012. Okay, so when they completed project A in 2011, there was the development expenditure that they have for it is 412,500. But project A is expected to result into a savings in production costs. And the first savings is expected to arise in year 2012. They now give us how the savings will come. 100,000 in 2012, 300,000 in 2013, and 200,000 in 2014. How are we to amortize such costs? You will amortize it in the same vein we are expecting the savings. So the amortization for 2012 now should be 100,000 divided by the total of that savings, 600,000, multiplied by the development cost of 412,500. That's how you calculate the amortization for that one. Project B that commenced in 2012, they've incurred 56,000 on it during the year, and they purchased a machine of 30,000 for use. The machine has a useful life of 5 years. At the end, there were still uncertainty concerning the completion of the project. That means project B cost, even though it's a development cost, should be treated as what? Expense, since they are still uncertain as to the completion. So what will now be the project cost to be expensed? The 56,000 they incurred during the year, and the depreciation of that 30,000 cost of machine that relates to the year, which means you will prorate the depreciation from April to December. That's what you will expense for as the development cost expenditure for 2012. Project C started in 2011, and the cost that they incurred on it is 36,700, which has been written off. That is, they've treated it as an expense in 2011 because there were still uncertainties surrounding the completion of the project. But now that the uncertainties have been resolved in 2012, they incurred a further 45,000 during the year. What will happen? The 45,000 will be recognized as an intangible asset. But the earlier 36,700 they've written off, nothing should be done to it. They don't need to bring it back to the account. Do we understand?
yes, sir.
Ladies and gentlemen, I hope I've been able to confuse and not to convince you. Sorry, I hope I've been able to confuse and not to convince you. I hope I've been able to convince and not to confuse you. I hope I've been able to do something to make IAS 16, IAS 38 clear to you.